Hi everyone, welcome back to Level Up with Dawn. Today we'll be talking about your mortgage bond rates and should you fix them. Let's get into it. Let's talk about our mortgages. This year has been unprecedented in terms of the rate cuts that we have seen from the MPC. Just as a side note, who's the MPC? The Monetary Policy Committee, and they are part of the Reserve Bank, and they decide what our repo rate will be. How they decide this is based on one goal. How is inflation going to look like? So if they think that they need to increase inflation, they'll reduce rates. If they think they need to decrease inflation, they'll increase rates. For this past year, they have been decreasing rates. Why? Because they're expecting inflation to come in at a lower number this year because people are losing jobs, less people have money, so they'll be doing less spending. And then that translates into lower inflation. Some people may think this is a good thing, but it's not actually a good thing because inflation is healthy. It's a healthy sign of the economy. It's the sign of a working machine, the machine being an economy. Let's say you're driving a car. When you drive a car from A to B, when you stop at B and switch off your car, if you put your hand on the hood of the car, you'll feel that it's warm. If you put your hand on the tires, you'll feel that they're warm. There's absolutely nothing wrong with that. It's just a sign that this car has been driven. This car has been moving. It's been working. What you don't want is your tires to be smoking and your engine to be overheating. You don't want that. But the presence of heat there is not a bad thing. You just need to control the level that it's at. And that's what inflation is. We've seen some dramatic rate cuts. In January, they cut the rate by 25 basis points, which is 0.25%. In March, they cut the rate by 100 basis points, 1%. In April, in an emergency meeting, another 100 basis points. And then just a few days ago, in May, they cut the rate by 50 basis points. So that's 0.5%. So in the space of this first 5 months of the year, the repo rate has decreased by 2.75%. And that is huge. That's a lot. That's a lot of savings for people who have home loans. That's a lot of savings for people who have repo rate linked loans. But then now that raises the question, should I fix my interest rate to make sure that I lock in these good rates where they are? And if tomorrow they decide, oh, we're good now, let's raise it back up, I'm not in a position where I have to pay more than I budgeted for. The issue with that is, with fixing interest rates, you don't get to fix it at the rate you are at now. So let's say you get a home loan at the bank. Let's say your interest rate is prime. And so because the repo rate has been going down, then prime has been going down for you. So you've been benefiting. But if you decide to fix your rate, you can't fix it at prime. The banks will never let you do that. They will fix it for you at prime plus 2%, let's say, on average, actually. They'll fix it at prime plus 2%. So then that works out to their favor. And you are not actually getting the chance to take advantage of the rates that we are experiencing now. So no, it's not a good idea to fix your interest rates just because you are going to be immediately putting yourself at a 2% disadvantage, which you don't need to. And as much as the repo rate has decreased so quickly, this has happened because there's an effort to stimulate the economy, considering everything that's happening now. So think about that. How long do you think it's going to take to stimulate the economy? Do you think just because now rates are low, by December we'll be back to normal? Is that likely? Is that realistic? If you're still watching, subscribe, like the video. I mean, we're halfway there, so you may as well. it's not going to revert as quickly. Seeing the past behavior of the MPC increasing the repo rate is a very thought out decision. It's not done in dramatic jumps. So don't count yourself out. Don't exclude yourself from benefiting from these rates. Yes, it's nice to have certainty, but it's because of uncertainty that we are having these good rates. And give yourself the time to take advantage of them. You don't want to be disadvantaging yourself from day zero with 2% higher rates than everyone else. If you are worried about the rates increasing and being in a position to um, pay more money than you expected per month, that's a valid concern, but don't address that concern with fixing your rate. Rather, address that concern by paying down your mortgage faster. Pay into your mortgage what you would have before all these rate cuts happened, so that you get that benefit of paying down your loan faster. And then, in that case, when the rates do come back up, you have a lower loan, so you don't have as high of a monthly payment. Or save some of that money, put it to the side in a tax-free savings account, or put it to the side in a fixed deposit, and let that grow at a certain percent, so that it's also growing in anticipation for when you need to use it as a buffer to pay off your loans. But please don't fix your mortgage rates. You're just counting yourself out of a good position, and I'd hate to see that, especially because it takes a lot for people to buy property, and I don't want fear creeping in and making this experience bad for people, or making this experience worse for people than it needs to be. So let me know down below, do you have any mortgage bonds or any loans that are linked to Prime that have been benefiting from these rate cuts? Also, do you have any fixed rate loans, or are all of your loans variable rates? Thank you for watching. If you want to see more content like this, please subscribe, please like this video and share it with someone that you think would benefit from it, and I will see you in my next video. Bye.